You are listening to Keystone's Stock Talk Show, episode 272.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again. I will start this week with a quick segment from our recent live webinars, which used past successes to identify three basic commonalities of 10X stocks. In our Your Stock Our Take segment, Aaron reviews a question on a company we sat down with over the past week, Cematrix Corporation, symbol CEMX on the TSX, a manufacturer and supplier of technologically advanced cellular concrete products. Last week, management announced that unforeseen delays on some projects will impact the company's 2024 revenues, expectations, and a portion of the 2024 forecasted revenue will now be realized in 2025. Aaron gives you his take on our sit down with management and the outlook for Cematrix. Brennan answers a viewer question on Element Fleet Management Corp, symbol EFN on the TSX, the world's largest automotive fleet manager with 1.5 million vehicles under management as at June 30th, 2024. Shares have surged in 2024 following solid growth and recent earnings guidance increase. Brennan lets you know current valuations and whether the share price gains can continue. Finally, Brett takes a viewer question on Softchoice Corporation, symbol SFTC on the TSX, which provides IT solutions ranging from implementation to management of IT environments. Brett gives you his take on the company, which does not appear to be producing revenue growth, holds a net debt position, paid a significant one-time dividend, and continues to pay a 2.77% regular dividend. All right, let's get to the show. My co-host, Mr. Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing?
Great.
Doing well.
Good.
Busy week last week. We did
yeah.
A couple of conferences, interviewed one day, I think 7 management teams, the next day 12. I spoke at that event. Then I came home and spoke at a traders virtual event online. So busy week.
I was supposed to be speaking at as well, but Ryan covered for me.
Yep.
Yeah, well, because we were interviewing at this we committed to that event in advance and didn't know it would cross over with this event so it ended up us having to kind of I jettisoned out of that event one company early. And it was a good event though overall in terms of management teams. Sat down with a number of companies, 3 or 4 that are currently in coverage that we have recommendations on, got some updates there, and then some potential new companies as well.
Yeah, I thought it was cool too. Just there was one podcast listener that came up to us and was like, "Hey, Keystone," and he was basically saying like that he feels like he knows us well just through the podcast. I think that's always interesting. I thought that was cool. And then as well, when Ryan was doing his presentation, I sat down next to an individual who was like, "Hey, Brennan, I was literally just in your guys' webinar 2 weeks ago," and I apologize that he had to basically sit through the same content when Ryan was doing his presentation.
You're
obviously very condensed.
That's
more you, but yeah, no, it was good. A lot of interesting company conversations or management interviews. We sat down with like Atlas Engineered Products, et cetera, and really just got some good color on these businesses, and we will continue to monitor and see if what they said comes to fruition.
Yeah, I do like the process of actually sitting down with the management teams, and sometimes that's difficult if it's a company that's, it could be across the other side of Canada, or it can be somewhere down in the United States. It's not always easy to sit right in front of management teams. You can use Zoom, you can use phone meetings to get a lot of the information, but when you're actually sitting across from them, and sometimes they're bringing like samples of their product, and you can see it and you can really kind of break it down and learn a little bit more about the company and the business model. So it's a good experience. I like this conference format where you can actually sit down with 14, 15 different companies over a few days.
That's good. And we reached our 4,000th subscriber. So my daughter says that's a big deal. We're going to give away another mug. Anybody who puts in a question over the course of this week, we'll draw one or two out of there and give away a couple mugs. So 4,000 subscribers, big round of applause. Quickly on our way to 1 million. That's all I can say.
Road to 1 million. Yeah.
Mm-hmm.
Yeah, well, the hardest is the first 4,000. That's what they always say.
That's
right?
what they say. After that, by next week, we'll have 50,000. That's what I heard. I did hear after you go to 5,000, it just, although you can see on our podcast, to be honest, it started to really incline like that. So
it's once we got Brett. It's once we got Brett, you know, Brett's bringing them in.
Mm-hmm.
It's all Brett. That's true.
Definitely. I'll take credit for it.
Speaking of Brett, you have a poll question, right?
Yeah, we got a poll question for this week. The question is, what style of equity investing are you favoring right now? Growth or value? Growth came in at 61%, and then value at 39%. And that's really the two, even though there's a lot of blending and people will have slightly different definitions, those are kind of the opposite ends of how people will view equity investing as value or growth. Growth being, the extreme growth example would be something like that is pre-revenue, doesn't have any earnings or cash flow, and it's all valued on being future growth, versus value. If you wanted to take a hard, pure value company, it would likely be a mature company with consistent and no revenue or earnings growth over time. But most companies are in between that. And that's really where you actually want to look for the most part, is not on the extreme ends. But yeah, I'm not actually surprised either that we have a bit more growth leaning right now, because you always have, once the interest rates start to drop, and I think that's really what's driving sentiment in the market right now as a broad market sentiment, it is when you have those low interest rates, people do start to prefer growth because money's cheap. So you can start to look farther in the future as the discount rate for any cash flows or earnings is lower. And that's not really surprising that our viewers are looking toward more growth.
Growth
I didn't like
at
that
a reasonable
question.
price.
I'll be honest with you.
I
didn't like this poll question. I'll be honest with you. Because it only gave
Tell
us
us
two
why.
options, right? Growth or value, and not the third, which would be to combine the two into a GARP approach, growth at a reasonable price. I couldn't just...
Brett likes to polarize people.
I was specifically doing that, just for the record. Ryan did mention something like that last week when I was making the question. And it's really just to see, like I said, the extremes, because obviously there is a good middle point, and that's where we want. We want that balance of growth and at a reasonable price. That's the name of it, GARP.
Aaron, you should know there's no middle ground in anything.
There is no middle ground.
No gray area. It's either one or the other. It's black or white.
This is true.
It's all
if somebody put a gun to my head and said you have to choose, I would probably the choice I would probably point towards would be value, but it would still be with the price sensitivity, or sorry, value. It'd be growth, but it would still be with the price sensitivity of value. So it's any. You can find a great company. It doesn't mean that it's worth an unlimited price, essentially. Yeah,
it's always we're trying to blend the two.
There's always,
it's a good
an upper bound on what something's value is or what its worth is.
Growth at a reasonable price. All right, we might as well get right into the show. Got a busy show for you. I'm going to then share my screen. All right, once again, we're taking another segment from our recent 10X webinars. I'm going to look at past success and the data here. This week, I'm really just going to focus on some recent examples of stocks that have gained greater than 10X plus from our Keystone's buy recommendations. Next week, we'll get into the data. Let's look at 5 recommendations from our research. These are 5 amazing capital compounding small cap stocks we have actually recommended to clients. Now, I share them with you here today mainly because they make us look smart. I'm kidding, obviously. What we like to do is study this group and find the commonalities in each success story and use them to guide our future investment decisions. This group not only includes 10X stocks, but 20, 50, 90, and in Hammond Power's case, 200X plus, truly portfolio changing stocks. Generally, what can we say about this group of 5 truly portfolio changing stocks? And I will briefly explore today the commonalities between these stocks to see if they can help us replicate past success into our future investment choices. So let's start by looking at size, because Brett said size matters. That was earlier. But by size, if we look at all of them, by market cap, that's how we're judging the size of these companies. Even a decade or so back, they were considered small cap companies. Below, we can see that not one had a market cap above about 55 million Canadian. So certainly micro to small cap. So I would say here, commonality number one would be each company started small before their share prices took off. Let's check industries to see if there's any commonalities here. So we have electrical equipment and parts, automotive repair services, paint protection for the auto industry primarily, engineering, geothermal, heating and cooling, and software. Now, if you think auto repair services and auto paint protection are the same industries, you're stretching the truth. The correct takeaway here is there's no commonality in terms of their industries. In fact, the wide breadth of the industries appears to suggest that there's far more important general factors at play here. So let's take a look at some basic financial metrics to see if we can find commonalities there. The first metric we look at is revenues. Did the businesses have any sales at the time of their recommendations before they started their ascent? We can see here, ding, 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 we have a winner, or in this case, 5 winners. Each business had produced sales prior to their ascent. Using a more stringent financial metric, were business producing net income at the time of their recommendations? Again, this is before they started moving higher. Once again, the answer is yes. Both not only were selling products or services, each were generating profits from those sales. Now, because net income is a far more stringent and specific criteria, financially speaking, and all match that criteria, we're going to take profitability as a more statistically impactful commonality. So commonality number 2 here between these great stocks is profitability. Let's examine whether any of the businesses were well known to investors or covered widely or even at all at the time of Keystone's original recommendation on these stocks. As we can see here in terms of coverage, Hammond, Expel, and Water Furnace had 0 coverage on our original recommendations. In fact, it took over a decade for any real coverage to show up on Hammond Power. Expel finally just got coverage a year after it jumped to the NASDAQ. Boyd had previous coverage but was abandoned, and Jana had a singular non-independent analyst when we started recommending the stock. Generally, unless you were a client of Keystone's, the average investor had no idea these portfolio changing stocks even existed on our original recommendation. So basic commonality number 3 is that each of these stocks were significantly unknown or underfollowed at the time of their recommendations. There are many other factors, including strong growth paths, good management, limited share dilution, that are relative commonalities between these 5 stocks. But I want to keep the exercise basic today to give investors a basic, simple framework from which to start when looking to find the next potential 10x stock. So I'm going to summarize that today. At recommendation and prior to their ascent, each company was small, profitable, and unknown. Next week, we'll see if the data backs up this anecdotal case for profitable, unknown, small cap stocks.
Yeah, I think that, it's kind of interesting just looking at like the industry breakdown between the few, because if I recall the story correctly, like Ryan and Aaron were both in Toronto not too long ago, and Ryan was on a panel just talking about where to find, these next best stocks essentially. And I know one of the panelists essentially was saying, to look for that next, or to focus on these great themes, be whatever it is, like,
for sure.
Thematic investing, where again, you can see kind of Ryan like outlines, who would have thought that, Expel, a paint protection company, or, Boyd, an auto body and glass repair company. Like, again, these aren't sexy themes, but they're good businesses, good cash producing businesses. And I just think it's interesting, especially when, we hear that in the market so often, where you need to be in, 3D printing, et cetera, et cetera, et cetera. And, if we can find a business in these themes that, matches our criteria, great. That's awesome. But again, just looking for the cash flow is generally what we're trying to do.
Yeah, and I always talk about this all the time. The last decade, I was on, probably 100 panels over that decade, and every time somebody has the greatest next theme, not once did I hear auto body repair shop consolidation being the great theme for the last decade, and yet that is what Boyd does. That was the best stock to pick on the Toronto Stock Exchange over the past decade. Anybody who said they picked that because it was a theme is lying. We're not driven by themes because we don't see investing really driven by themes over the long term. You're looking at great businesses that generate cash flow and compound that over time. And that's what we're looking for. And that showed you there was no commonality in the industries. It showed you there's something else at play. And I think those three factors there, small unknown, and growing with profitability, and that's really what we saw be a common theme. The data will bear that out. I'm going to give you a sneak preview of next week, but the data bears that out as well.
I suppose you could say that, that is Keystone's theme. Profitable, cash flowing businesses that compound over time, under followed.
And they don't have to be small.
But that's a theme for the ages, right? Yes, that's not a theme that goes out of style in 6 months, right? Or just out of favor. And just on Brennan's comment as well about, we'd love to invest in exciting themes when we find profitable businesses that pass our criteria in those themes. Well, that's also how we know that the theme is real, right? That there's something actually behind it, investable, right? I mean, if it's a theme where, no companies are able to produce any type of profitability or cash flow or, in some cases, even revenue, then what, at best, it's too early. You're pre-commercialization, and at worst, it's a false theme.
Yeah. And once once you really see those themes start to evolve, once it's been recognized as a theme, a lot of those times you are being that macro investor, that industry investor, and a lot of those companies have already went up substantially in price. Once you're starting to see like those thematic ETFs or funds and so on, those have already appreciated a lot. And a lot of the time when you're buying those ETFs or funds, which Ryan was talking about last week, is you get a lot of stuff which just doesn't even fit that theme. Ryan was talking about the small caps last week where they weren't even fitting the market size. But then in thematic investing, a lot of times you'll see stuff is tangentially related to some theme or something, but it doesn't really expose you to what you actually want. So then at that point, you need to go to individual companies, which then you are looking at more of a micro bottom-up approach versus a top-down thematic investing approach at that point.
I'd rather honestly back into a theme or accidentally come upon a theme by having 15 to 25 great cash producing, relatively undervalued growth stocks in your portfolio. That's what happened with Hammond Power. I mean, I did talk about them in a speech about 8 years ago as a way to play electrification, but that's not the reason we're buying them. But it happened to be they played into a theme of electrification, but we already own that before all of that because they're a good company, good growth. And if they happen to catch a theme, then you can, get a higher multiple than people would have thought for a business such as that. And, if you have 15 to 25 of those in your portfolio have the potential of catching a theme with an undervalued stock, then you get not only the growth that comes with that stock naturally as it grows its earning, but you get a multiple appreciation and expansion of that multiple. And that's where you can get a real tremendous winner. And that's why one of the reasons why Hammond has been such a great company to own for, particularly the past 5 years, but, it goes back 20 years, really.
And I guess my last point is too, it's not that we won't focus in on a theme and look through every single company in that specific sector or whatnot. We have done this, but in many cases, we'll do these comprehensive reports, look at all the names across a theme, and come to the conclusion that we can't recommend anything. This does happen. So again, we're not just recommending to be in the sake of a theme. Again, it needs to match our investment.
Yeah, and I'll give you an example of Aaron we wanted to include cybersecurity into our research, and Aaron looked at every cybersecurity in Canada. The problem was there's 4 or 5. We moved and there was basically nothing that would meet our criteria. Moved to the US, and there's about 58, 60 companies, and we were able to 5 and Fortinet, and now it's up 400, 500% since that time. But that was a way to apply our criteria to a theme. If there was nothing that met our criteria, we wouldn't have had a recommendation there. There happened to be a couple companies, and we picked what we thought was best in class, and it's done well. That's a way of applying our criteria to a theme and successfully investing in a company that we continue to own and hold for clients today. All right, let's move on to our next segment. Aaron's going to take a question and review kind of a company that we sat down with over the past week, Cematrix. It's semantics, really. I don't know. Cematrix. If you want to go through that, Aaron, right now, that would be great.
Cematrix, I think we'll call it Cematrix, like cement, cellular concrete solutions. Okay, so we'll take a look at Cematrix here. And this is a company, we were just at a conference in Vancouver where we were able to interview about 15, 16 management teams. One of those companies was Cematrix. And we also just recently received a question from a listener as well about the company. So I'm happy to go through and take a look here. Cematrix is a company that just recently uplisted to the Toronto Stock Exchange, TSX. Symbol is CEMX. The price is about 25 cents per share right now. And it has about 160 million shares outstanding. About a 50 million market cap or so. So what does the company do? They're a company that manufactures and supplies cellular concrete products developed from its proprietary formulation. And they sell to infrastructure customers across North America. This is a unique cement-based material, provides thermal protection, and offers solutions for various challenges in the infrastructure, industrial, energy, and commercial sectors. So there are a lot of different use cases for the company's cellular concrete within the infrastructure space, from tunneling to highways to insulation and many more. But where they see their real competitive advantage in this technology is just the benefits that it provides their customers to utilize it. So they, based on the information from their presentation, it's about 40% less cost, 25% less emissions, also less excavation, and also less trucking as well. So they say that it just makes sense both environmentally and economically for infrastructure companies to utilize their cellular concrete. And they see this as a major opportunity, as a lot of expenditure is expected to happen within the US infrastructure space. And that's really where they believe that they're well positioned. But let's take a look at the company's recent financial results. They put out their Q2 financial results not long ago. We can see revenue 6.4 million, up about 3%. Negative operating income minus 1.1 million. And then also negative cash flow from operations of $500,000, comparable to the second quarter of last year. So for the 6 month period, revenue is up 11% to almost 15 million. A good expansion in margins, and we did see some positive adjusted EBITDA and some positive cash flow from operations, but operating income was negative 0.8 million for the 6 month period, compared to negative 2.1 million for the 6 months in first 6 months of 2023. So recently, the company did announce that there were project delays that will be impacting their financial results for 2024. These were projects that were supposed to be delivered this year. Now they're expected to be delivered in the first half of 2025. So what this really does, it does set the company up for a strong first half for next year. So we would expect to see good growth in the first 2 quarters of 2025, assuming that these projects actually go through as planned at that point in time. But there's a bit of a flip side to that. So although the financial results should look very good in 2025 compared to 2024 based on these projects, when we now fast forward to 2026, they're going to have a hard time beating those numbers in 2026. So what we do see is some volatility in fluctuation from quarter to quarter and even year to year in financial performance from Cematrix. But right now, they are stating that they have strong fundamentals supporting growth going forward. Backlog of 84 million. They have a bid pipeline that they're estimating at approximately 450 million. They say they have 200 million US dollars in seasonally adjusted production capacity. So lots of ability to essentially increase production in order to meet demand. And they believe they're very well positioned to capitalize on US infrastructure spending. There's an estimated 550 billion that will be spent on roads, bridges, and public transportation in the US. But we want to, so, things look good. And I found from our conversation with the company, it was a very interesting conversation. I like the idea of a stock that is providing exposure to the infrastructure build in the US. And I like companies that have proprietary technology that with good, solid use cases. So it seemed to be the case, but we also have to look at the financials of Cematrix here and see, is this technology, is it actually producing a business that is generating positive cash flow and good growth and strong fundamentals overall and fitting the Keystone model. So we'll start just by looking at revenue over the last 11 years. Now, I will say that the general trend in revenue is up. There is huge growth in 2023, 53 million in revenue compared to about 30 million in the year before. But, we can definitely see there's a lot of fluctuation in revenue, on some years going up and some years going down. We see quarterly fluctuation, but, recent revenue growth is strong, and the general trend does seem to be that revenue is moving in the positive direction. Unfortunately, we cannot say this about profitability. So the company has not managed to be able to produce consistent and meaningful profitability over time. 11-year history that we're looking at here, and in only 2 of those years was net profit positive. In all other years, the company had a net loss. So we saw some profitability in 2023 last year, but only 1 cent. And then for the first 6 months of this year, negative earnings. So definitely not looking like the company is being able to drive a lot of the benefits of its business model down to the bottom line. And of course, they have bills to pay, and they need to offset those losses. And the way they've been doing that is by issuing shares. So a massive increase in shares outstanding over this company's history. We saw that begin in 2020, but really accelerate in 2021. And it's continued since then. So 137 million shares, weighted average shares in 2023, but that has increased again because now we're up to about 159. So we really like companies that are able to maintain a strong capital structure, meaning not too many shares outstanding, and also companies that aren't reliant on having to issue shares. We want to see that. We want to see the company. We want to see a sustainable business based on the company generating cash flow that it's able to not only offset any of its expenses, but also reinvest in the business for future growth and not being dependent on equity issues or debt. So we can see here from the 5-year chart that the shareholder return has really kind of reflected some of the issues that I've talked about. Very volatile stock performance over the past 5 years, really flat over a 5-year period, but, a lot of up and down, and a huge downturn from, 2021 to 2023. Now, the company just recently uplisted from the TSX Venture to the TSX Exchange, and this happened in July. One might expect, and the idea generally is that an uplisting would be positive for a company share price. But they uplisted at about 44 cents, and they're now trading at about 25 cents. So we've seen, a pretty significant drop here since that uplisting, and that likely has to do with the project delays. So looking at the company, our take, an upward trend in revenue, certainly recently, good growth in revenue. They should have that strong first half of next year due to those project delays. That is, again, assuming that the projects are actually started and completed in the first half of next year. And we think it's an interesting technology, and we like the exposure to the infrastructure boom, but the company really lacks meaningful and consistent profitability. The huge increase in shares outstanding over time is a problem for us. And we also expect financial performance to fluctuate from period to period. So we're not seeing profitability. We're not seeing a smooth trend of growth here, unfortunately. The company does not fit Keystone's model for investing, which would, of course, be a growing company where there's a lot of profitability being delivered to the bottom line. We will continue to monitor the company. It's certainly not something that we have any intentions of recommending in the near future. But if we could see it transition to more consistent and meaningful earnings, then it would be something that we would take a further look at.
Yeah. It's a company we looked at for years. They've had positive outlooks in the past, but it's the history of weak profitability really that is in the business. Significant share count increases, and couple that with some positive outlooks in the past that hasn't necessarily translated into anything other than some revenue growth. It's great to see the revenue growth, but we need to see profitability. It looked like they were potentially on track for a kind of a breakout year this year, but again, those orders were pushed forward into next year. So we could see it should see a positive first half of next year, but can they again beat that going into 2026? If you're just in fits and starts here, and more fits than starts really, that is the issue. We just need more consistent profitability from the business, and it hasn't been there, just based on the numbers. Nothing to do with the technology. Looks interesting, and you'd think there would be further adoption, but it started to come, it looked like, this year. But again, those project delays are hurting the business. All right, Brennan, you're going to look at Element Fleet Management Corp, EFN, on the TSX.
Element Fleet Management Corp, EFN, on the TSX. Currently trading at a price of about $28.50, $11.5 billion market cap, and about a 1.7% yield. So they're the world's largest automotive fleet manager with 1.5 million vehicles under management as of June 30th, 2024. And the company offers fleet services, including vehicle acquisition, maintenance, accident handling, remarketing, and EV integration to corporations, governments, and not-for-profits across North America, Australia, and New Zealand. And they have also been expanding operations in Europe and Asia. So the last time we covered Element on the podcast was by Aaron in December of 2023. Well, it traded at a price of about $22 per share. So over the past 9 months, the stock has performed decently well, up approximately 30%. But let's dig into why we have seen the positive share price performance and if we believe that can continue. Now, looking at the recent financials for Q2 of 2024, keep in mind all the financials I'm referencing here are in US dollars. And if you go back and compare this analysis to Aaron's video from December, note that all of the figures Aaron highlighted were in Canadian dollars, as the company has now switched its reporting currency to USD. And as Aaron mentioned last time, the company markets themselves as a fleet management company, which implies a service business. But there's also a lot of financing in the business as well, with 51% of revenue being from services, 45% from financing revenue, where essentially they are making loans and receiving interest payments on those loans. And then 4% of revenue is from syndication revenue, which from my understanding is leasing services. So actually looking at the numbers here, revenue increased in Q2 14% to $275 million, led by growth across all of its revenue lines, with service revenue up 11%, financing revenue up 16%, and syndication revenue up 42%. Net income, this is accounting net income, was up 15% to $103 million roughly, and adjusted EPS was up 16% to 29 cents per share, both being driven by margin expansion, as adjusted operating margin was about 55.7%, a 60 basis point increase year over year, which management indicates is from positive operating leverage, as net revenue growth has been outpacing growth in operating expenses. And the balance sheet has about 83 million in cash, with $8.7 billion in debt and leases, providing a net debt position of about 8.6 billion, and the company has a trailing net debt to free cash flow multiple of about 8.5 times. Now, moving to the company's guidance, they recently raised it given the strong performance in the first half of fiscal year 2024, now up to revenue of 1.06 billion to 1.08 billion, which is an increase of about 11 to 13% over 2023. Adjusted EPS is now expected to be $1.07 to $1.11 per share, representing an increase of 9 to 13%. And adjusted free cash flow per share is now expected to be $1.32 to $1.36 per share, up 6 to 10% over 2023. However, I will note that the company is isn't removing any non-recurring costs associated with its strategic initiatives, as well as the acquisition of Autofleet, which I'll briefly go over here, which may lead to a bit of a drag on accounting earnings as the acquisition is integrated. And using this guidance, the stock is trading at about 20 times forward adjusted EPS and about 16 times forward adjusted free cash flow, while it's anticipating growth of about 9 to 13% in adjusted EPS. So to put this into perspective, when Aaron covered the stock last, it was trading at about 17 times forward 2023 earnings with expected growth of 14%. So relatively speaking, the company is a bit more pricey for less anticipated growth as compared to where it was at December 31st or December of 2023. And just a few operational updates here. As I noted, the company announced the acquisition of Autofleet on August 13th, 2024, which is expected to close in early Q4 of 2024. Now, I couldn't find much information on the acquisition details itself, such as a price paid or its financials. So we're kind of left in the dark there. And the company also provided a strategic initiative update, which included the plan to optimize the business by centralizing the US and Canadian leasing operations and establishing a strategic sourcing presence in Asia, which is expected to provide a run rate revenue of about 30 to 45 million by 2028. So, that's still quite a ways out. And furthermore, in August, the company also commenced operations in Dublin. And in April, they announced commencing operations in Singapore. As you can see, the strong financial results year over year in the first half of 2024 have led management to increase their guidance for fiscal year 2024 and has, of course, led the stock higher given this performance. Now, the yield of 1.7% is decent, and the company continues to increase its dividend up from an annual dividend payment of about 10 cents per share in 2016, now up to 48 cents per share in 2024. With a payout ratio of a roughly 30% GAAP or accounting earnings per share. Now, fundamentally, the valuation isn't unreasonable on a forward adjusted EPS and adjusted free cash flow basis, but it may be on the higher end given nearly half of the business comes from financing revenue. And as Aaron mentioned back in his last segment on Element, it is difficult to value the company given the high composition of financing activity that the business conducts, as the valuation appears more attractive if we value it as a fleet management services business. But as a financing business, we would anticipate the valuation to be much lower, given, again, like he referenced, banks are typically trading around 10 times earnings. And as a composition of total revenue, we're actually seeing net financing activity increase by a few hundred basis points as a portion of total revenue compared to when Aaron looked at it last. Now, I'll also note that the debt leverage remains relatively high for the business. And all in all, we don't think that it's a bad company. There continues to be momentum in its financials, but at this time, we continue to monitor. And, just for the listeners out there, I'd like you to leave a comment, if you think we should be valuing it more as a pure fleet management services company. But, generally seeing that financing revenue, it's tough to do so in our opinion.
Yeah. And one of the challenges, that I've had with Element is just exactly like what you've said, is that when you look at their materials, they always market themselves as a fleet management company, right? But, they're really every bit as much a finance company, right? And as you
Yep.
said, finance companies typically trade for lower valuation unless the growth is extremely exceptional. But even then, it would be a lower valuation relative to companies that, are in other industries, maybe like tech with the same growth. So the point just being, it's kind of a difficult company to value. I think 20 times earnings for, a fleet management company, if you're looking at like, long-term contracts, recurring revenue is reasonable. But, at 20 times, it doesn't look certainly like it's undervalued to me. And then that's a pretty heavy debt to EBITDA ratio as well.
Yeah.
So high debt leverage.
Yeah.
Yeah, I would say there is some significant risk in the company with the current valuations. It's not overtly expensive, but based on what a typical financial company would be valued at, it is in the higher end. Okay, so let's move on to our final company, Softchoice Corporation, SFTC, on the TSX, IT solutions company, relatively recently relisted on the Toronto Stock Exchange.
Yeah, so it actually relisted in 2021, but it was previously actually a public company in 2013 for a few years, and it was taken private. The same people who took it private still own I think it's around a 45% stake in the company still. But yeah, it's been relisted a few years ago. So Softchoice, symbol SFTC on the TSX, provides IT solutions ranging from implementation to management of IT environments. So these are things like cloud database management, hardware lifecycle management to cybersecurity, anything really in that area they operate in. The company operates in Canada and the US. Softchoice breaks down its services into a bit more manageable segments of software and cloud, services, and hardware. The company does as well have notable partnerships with Microsoft, Google, and Amazon, with the big one being Microsoft there, but they have partnerships with all the big cloud hyperscalers. Softchoice currently pays a dividend yield of 2.8%. Like we said, the company IPO'd on the TSX in May of 2021 at a share price of $20 and has since fallen to the current price of $18.72 over the past 3.5 or so years. However, it is actually up quite a bit year to date, up 20%. As well, it paid a significant special dividend of $4 during the year. You can see when they did, and when it actually got paid at the ex-dividend date, it went up $4, then went down $4, exactly by that, minus a few cents effectively. So far, though, good return this year. You get $4 special dividend plus some share appreciation of $3.35. First, can look at a high-level long-term financial view. On a per-share basis, revenue has been declining over the past few years. You can see that in the light blue on the left graph. And although choppy, EPS has generally improved since the IPO or the re-IPO, the company does have some seasonality, with Q4 and Q2 being stronger due to customer year ends, primarily in Q4, but as well as Q2, as that's Microsoft's fiscal Q4 being aligned with Softchoice's fiscal Q2. And as Microsoft-related sales account for 29% of net sales, it's a big player for Softchoice. Prior to the special $4 special dividend, the company did have a declining net debt position, but with the dividend being primarily funded by debt, the company now actually has a higher debt load. This is something that we don't generally like to see under a long-term hold view, as issuing debt to pay a dividend decreases the value of the company after the ex-dividend date, as you will no longer receive the dividend, but you're bearing the weight of the debt. So really, it's that trade-off is gone. If you've missed that ex-dividend date, you're losing value at that time. So moving on to the Q2 financials, with the figures being in US dollars, the company saw a 7% decline in net sales to $193 million. However, it did have a strong revenue retention rate of 100% for its recurring services. And a gross profit did actually increase by 12%, largely due to improved margin in the software and cloud segment, increasing the margin of 73% from 70%. Additionally, services improved, offset by a lower hardware gross profit. But the story of the business that really drives the financials is that software and cloud, and we can see that segment is doing well and is driving the profitability. Moving down the income statement, operating profit increased by 16% to $22 million, powered really by that increased gross profit, offset by slightly higher SG&A. However, further down, we can see a rise in non-operating costs, primarily those finance costs, substantially increased to 4.8 million from an income of 1.1 million. Last year, the income was driven by foreign exchange. So that's really out of management control. That's something you just have to observe. You have to realize it, but it's not going to be something recurring, and it will fluctuate quarter to quarter, year over year. It's just something you have to take as it is. However, the change that is under management control to a degree is those finance costs, primarily interest expense on the revolver that they had increased to pay that dividend. The interest expense is now at 5.8 million from 3.5 million, offsets 2.3 million of that 3 million operating profit increase. You can link that to that dividend earlier. So operating profit is actually down because they paid that dividend, and that's right there in the financial cost. The revolver now is at 194 million, up from only 39 million at the start of last year. Ultimately, this has resulted in net income falling about 14% to 12 million and diluted EPS to 20 cents. Moving to the balance sheet, like I said, the company has a net debt position of 190 million, primarily composed of that revolver that saw an update due to that special dividend. The company has a net debt to EBITDA leverage ratio of 2.3 times. As well, the company does actually have a lower current ratio of only 0.8 times due to the higher trade payables compared to lower receivables over time. It's been the trend of payables still ticking up almost on a quarterly basis, while receivables has slowly went down. And further, another sign of a bit of a concern on my part, it's not the end of the world by any means, but the company has already engaged in receivable financing for 12 million of its receivables at about a 1.5% discount. This is generally not optimal, as you are receiving less cash at the end of the day, and it means that you need to top up your working capital. That's normally the sign that it gives when you are doing receivable financing. It's not something which you generally want to elect into. It's more by force, even though they do have some financing wiggle room there with their revolver, having about, I think it's another 160 million in room. They have actually opted for receivable financing already. Looking at the valuation, the stock trades at a gap PE of 22 times, a price to free cash flow, removing the impact of working capital of 20 times, and an EV EBITDA of 12 times. I wouldn't consider the company to be cheap, even being a software-oriented company, as the growth and the risks don't really support any premium valuation. If anything, they support a discount valuation at this time. So moving forward, or concluding, I should say, the company is profitable and is growing slowly at a choppy rate, but it has not been really a particularly high overall growth rate for the past year. Net sales on a per share basis has been declining. EPS is ultimately more important than just pure sales, but at a point you do need to support EPS growth with some sort of revenue growth, especially on a per share basis, as you can only get so much margin. You have that limit of 100% margin theoretically, and you at that point would need revenue growth. I don't like the issuing of the special dividend that is supported almost purely by borrowing or debt. There are times to do special dividends, but in my opinion, if debt is required, it lowers the long-term value of the company almost all the ways. Further, the company has had to conduct that receivable finance, which can be another worry given the financials, not poor but not great current ratio, driven by the trade receivables and payables, which could, if they need to, they would probably likely draw on that receivable, but that then further causes higher interest expense, which they, of course, would benefit from a lower interest rate environment, which might be why they're seeing this as an opportune time to do these sorts of things. But ultimately, even if interest rates are lower, you're seeing a drag on the company from interest expense if you are taking on either more revolver, if you do have to issue a long-term debt note in some sort. It's ultimately, it does create a drag on net income. Lastly, the valuation metrics are not overly appealing given the growth and the risk at this time. This is something which I'd really just monitor at this time. If they do change up a bit, I don't really like those special dividend issues, which some companies and investors do, but that's not something which I would like to see, as I do view it as lowering the long-term value of the actual company, not just the returns of the company. It actually can impair operations at the end of the day.
Yeah, and again, I echo the statements on the special dividend. It seems like a payment to shareholders, basically not in the best interest. A one-time payment, maybe to management, not in the best interest of long-term shareholders when you go to a significant net debt position. Then, so it doesn't make a lot of sense. It impacted EPS, which impact the company's quarter, which impact valuations on the stock. So robbing Peter to pay Paul, it doesn't make much sense to me.
Yeah, on that, like the debt leverage isn't absurdly high. 2.3 times off standard EBITDA isn't absurdly high by any means, but it's the reason why they got to that point, which is the concern.
Yeah.
And you can see right in that.
Did you not have better places to grow, to put your capital is the other question. Could you not have made an acquisition, create something yourself internally to grow organically? What was the impetus to pay that dividend out at that point? That is, to me, a bit strange.
Exactly. It's really, to me, when I see that, it's borrowing from the equity's future and you're paying it right now. Yeah. So if you can't really achieve that growth, like Ryan was saying, that's the only way it would make sense mathematically, is if you were expecting lower growth than what your weighted average cost of capital would be.
Exactly. Yeah. No. Okay. I think that'll end our show for this week. Again, keep a question coming in, your stock, our take. We will pick one or two of those. There's the mug. Get a brilliant mug sent off to you. Again, if you're watching this right now on YouTube, more and more subscribers. Great to see. Smash that subscribe button. Or if you're listening on wherever you consume your podcasts, rate and review us, and we'll keep providing this content on a weekly basis. Thank you very much, and profitable investing.
Thanks, everyone.
Thank you.